Good morning, Rupesh. Just wanted your thoughts and wanted to understand what are these concerns that are emerging with respect to the power sector. What are the fresh concerns? Because we already know about the DISCOM pain, about the coal shortage issues. Because recently you have a lot of bankers, even the likes of SBI, who have come out and spoken about being worried over some of the power sector exposures.
Good morning. As far as the FY 18 years is concerned, we have seen a lot of issues like a lower system demand. Then there was lack of long-term PPAs that was signed by the DISCOM. And coal supply was a slightly issue because of REX availability was low. But, and obviously we have seen FY 18, the companies have underperformed relative to market. But in FY 19, we are expecting some sort of recovery in terms of demand growth. We are expecting close to 7.5% kind of power demand growth. Secondly, there are a lot of initial signs of demand recovery is there since last quarter. So sizable recovery expecting because of industrial capex recovery. Then we have seen this government last mile connectivity program that will unleash some of the latent demand, and we expect some resumption of long-term PPAs once the SEBs would get successfully implemented. So FY 19 is expecting to be a better year for power companies, but still we believe that regulated players like NTPC, Power Grid, those companies will do better as some NPA issues are there with the private players.
Rupesh, I don't know if you're tracking the updates with respect to a possible merger or a possible combine of NTPC, REC and PFC. But if this were to come about, what would it mean for something like an NTPC, and what would it also mean something like an REC or PFC for that matter?
Yeah, this is a proposal, and now they will talk with the Minister of Finance and financial lenders. I think it's a good proposal because out of 40 gigawatt of the stress assets that was identified by Minister of Power, we believe that 25 to 30 gigawatt are still reviable assets. And the companies like NTPC or PFC, REC, they have financial muscles, and they can, because if you look at the past record of NTPC, they have made a lot of loss-making companies into profitable business. But it's a win-win situation for both power generation companies, financial lenders, and distressed assets. Slightly negative for NTPC because people were expecting that there will be growth for NTPC in terms of inorganic growth. But looking at all these assets, 40 gigawatt assets, though most of these assets are not under NTPC's buyout candidates, because clearly they have mentioned that we want plant with more than 500 megawatt capacity, and most of these plants has to be based on indigenous equipment. So most of this around 25 gigawatt is not under NTPC's takeover criteria. So we don't believe that NTPC will have very negative impact because of this. There are other assets of close to 15 gigawatt which are very much viable that NTPC can have a target.
Rupesh, I want to shift focus to the peak power demand, which is expected to rise given that there is a forecast for higher than average temperatures. Is there, and of course there have been concerns over the total coal inventory lying at certain power plants. Do you believe that there is adequate coal supply and some of these power plants will be able to meet that sort of peak power demand? And broadly, what are the steps you think that the government could take to resolve some of these power company issues, be it thermal power plants, solar, or even on the power distribution side?
See, if you look at the last 3-4 months, the coal supply to power plants has come down drastically, mainly because of REX availability issue. But now clearly there is a talk that the Power Ministry, Railway Ministry has set some the tracking system whereby they will track the ongoing status of coal inventory at power station, then coal supply. So a lot of initiatives are happening there, and Railway has ensured that they will supply close to 615 million tons in FY 19, and availability of REX will be around 288 REX per day. So some and again another initiative measures that they want to bring down their average loading time. That will also have impact on the coal supply. And some of the Coal India's mines, I mean, close to 21 mines have got environmental clearances, which will add close to 43 million tons in FY19. And 11 new coal blocks have also added. The target which I have set up by Coal India is quite realistic, and because of this higher REX availability, we will see the higher coal supply to power companies. That is one factor. And secondly, that because of Uday implementation, a lot of distribution companies will sign PPA. And secondly, there is some recovery, industrial capex recovery is happening. That will also add to the demand growth. So overall, we are expecting that FY19 is going to be a good year for power companies in terms of demand growth.
Okay. But as far as the Mundra plant is concerned, Rupesh, the under recoveries continue. So where does that leave Adani Power and Tata Power?
See, for Tata Power, I think their coal and the renewable business are doing good. But still our hang is there as far as the Mundra is concerned, because under recovery is still close to 80 paisa per unit. And recently we have seen that the coal price is continuously moving up. It's now close to $100. For 6,300 calorific value. So that concern is there for Mundra. Now the option could be either to equity stake sale that they are talking with the beneficiaries. That can be a viable option and a trigger for Tata Power. As of now, Mundra overhang is still there, and that might cap upside from the current levels.
Rupesh, I was actually going through a few reports with respect to NTPC right now, and what we understand is that while the third quarter hasn't been fantastic, analysts across are willing to give it some leeway with respect to the possible implications. My point is that analysts so far are willing to remain at least slightly positive in the near term. I have some expectations of generation of return on equity for NTPC at around 14 to 15%. How are you viewing trade with respect to NTPC, and how are you viewing it from an investment horizon?
We are also positive on NTPC. Firstly, that in the next 3 years, we are expecting close to 17% kind of a CAGR growth in their regulated equity base, which is currently at 503 billion rupees. The why high regulated equity growth is mainly because the capacity they are targeting to add in FY19 and 20 is close to 10 gigawatt capacity. Already capacity which have commissioned in the last year now is getting added in the gross block. That will add to their regulated equity. So what we have seen in the last 3-4 years of low earning growth, low regulated equity growth, that scenario will change completely in the next 3 years. Next 3 years, we are expecting higher growth in the return on equity. Earnings could be around 18% CAGR growth, and capacity addition as well as a strong balance sheet. And the valuation is at a historic low valuation. It's trading at just about 1.1 times price to book value and 11 times PE. It's reasonable. Strong upside is there from the current levels. And we are expecting that target price could be around 213. So a decent upside from the current level at about 25%.
Okay, Rupesh. So just to sum it up, given the current situation, which companies do you think are the best place from an investment perspective? I just want your pecking order.
See, in the regulated space, generation side, we are expecting NTPC will do better in FY19. In the transmission space, we still believe that the power grid will continue to deliver good earnings on the back of higher capitalization. So there we are expecting close to 30% kind of potential upside from the current levels. Our target price is 256 rupees. And in the private space, we have some positive view. Not hold recommendation on CAC and the Tata Power at this valuation, while we maintain our negative view on the Adani Power and JSW Energy.